Hello, this is Joe Pryor with virtualrealestateteam.com in Oklahoma City, a part of Redbud Realty and Associates, and this is part 3 on investing in real estate and why you should invest in the Oklahoma City market. Now, in the last video, we went over a couple of important qualifications for judging why a house is not just a good buy for the money, but also why it's a good investment, and that is how to compute capitalization rate and cash on cash. Two short-term snapshots of how good that investment is, real numbers that you can get probably in the first year. And in that respect, you can decide if it meets your parameters. Now, there is another way that we evaluate whether it's a good investment or not, and that is called internal rate of return. Now, internal rate of return is defined as the amount of money that you're making percentage-wise annually as long as you keep all that money in the investment itself. So what's going to be different about cash on cash and cap rate is we're going to take everything we talked about there. We're going to talk about maintenance. We took property management fees, principal, interest, taxes and insurance, vacancy allowances, all those things that would constitute how much money do we have left at the end of that first year, how much money do we get back. But now what we're going to do is we're going to compute how this money goes over a period of time more than 1 year. So for instance, let's say we say, okay, let's see what this investment looks like over a 7-year period. That's 5 years, 7 years, 10 years is normally a good reference point as to judge what kind of return that you're getting. Now we're going to add a few other things to this that we didn't in cash on cash and cap rate. For one thing, we're going to talk about appreciation. Now, we're going to be very conservative. I know everybody's a little nervous about that over the last few years, but Oklahoma is one of the 2 states in the United States, North Dakota being the other one, that actually has overall appreciation this year because we haven't lost value since 2007. We're doing pretty well. We're still going to be very conservative about that. Then the other thing that we're going to add into this is we're going to add in that you're going to take your positive cash flow, which is the reason why you should be buying this, and we're going to be putting into some safe investment that's going to yield you 2 or 3%. And that is money that you're also making on the profit. That's money that stays in the investment. So this is the numbers that we're going to come up with at the end of 7 years, and it's going to be a pre-tax and an after-tax rate. So what we're looking for is if we take all your cash flow, we take some appreciation, now we also take the purchase price, which in this case may be $75,000, but it's worth $100, and we're computing in $25,000 in equity also. And at the end of that 7 years, not only do we have a percentage annualized that we're getting back so you can compare it to other investments that you have, but also we're going to look at wealth accumulation. We're going to look at what kind of money do we have. If we invested $16,000 and we go to sell the property at the end of 7 years, how much money is that? Is it $60,000, $70,000, whatever it happens to be? That is your wealth accumulation. Then what we're going to do is we're going to compute and show you before tax. Now we're going to show you before tax because we want to compare it against things like mutual funds. So if your mutual fund averaged 12 to 15%, but you average 20 to 23% on your real estate investment, you can say, hey, that was a good use of my money. Now we're also in a later video going to talk about a 1031 tax deferred exchange, which allows you to sell the property and not have to pay any taxes on the money that you made. So we'll deal with that in a later video, but that's why we want that pre-tax amount. Then what we're going to do is we're going to give you the after-tax amount. We're going to say, okay, at the end of 7 years, we're going to just cash out of this. Now, if you do that, the reason why we do the after-tax is because there is taxes. Number one, there's a tax called a recapture tax, which is 25% of your depreciation. That's taken off first. Now, in a later video, in fact, I think in the next video, I'll go ahead and deal with tax ramifications and depreciation and how this can offset your profit. But that's the first thing that we do. And so then we take that amount of money, we reduce it down to what that net is, and then we take capital gains. And capital gains right now is 15%. So that may change here over the next 5 years, we don't know. So that is, after those taxes are computed, then what we do is we say, okay, based on what you now netted after tax, this is the percentage of annualized return that you get. That way you know exactly what you're getting into. So that is internal rate of return. As I said, it's like cap rate and it's like cash on cash, but we add some other factors, including the amount of time that we expect to hold the property. Now in the next video, I'm going to go into that depreciation and capital gains with you to explain a little bit more about that. This is Joe Pryor with virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.